Hey everyone, and welcome back to the Deep Dive. Today we're going deep on financial reporting quality.
That's right.
Not just for our CFA candidates out there, but for anyone who really wants to be a smarter investor.
Yeah.
So we're going to go beyond just, what are the numbers? What's on the balance sheet, what's on the income statement to, what do they really mean?
Absolutely. And we'll be looking at, the whole spectrum of financial reporting quality.
Okay.
We'll go from the, squeaky clean reports that, make decisions really easy to the ones that you really need to put on that kind of financial detective hat to figure out what's really going on.
Okay, so, what are we looking for, I guess, right off the bat when we're trying to understand the quality of a company's financial reporting?
Well, I think first and foremost, you want to make sure the information is, what we call decision useful.
Mm-hmm.
So is it relevant?
Okay.
And does it faithfully represent the company's, economic reality?
Okay.
But we also need to think about earnings quality.
Yeah.
Are these profits sustainable, or are they just a temporary boost?
Okay, so how can we tell if earnings are built to last?
Yeah.
Or if they're just kind of, a temporary thing?
Well, one of the, classic tricks is to manipulate when and how much revenue and expenses get recognized.
Mm-hmm.
Companies might try to, shift things around to make the current performance look better.
Right.
Even if it means, sacrificing profitability down the road.
So they might try and pull future sales into the present to boost their current numbers or something like that.
Yeah, exactly. It's all about managing those optics.
Yeah, that seems pretty short-sighted.
It is.
What are some other shenanigans we should be watching out for?
Well, another common tactic is playing games with classifications on the financial statements.
Okay.
So, for example, a company might reclassify inventory from, being a current asset to being a long-term asset.
And why would they do that? What's the benefit to them?
Well, so, take a company like Merck & Co. Back in 2003, they did this. And what they were able to do is artificially, improve some of their key ratios, like their days in inventory on hand, and their current ratio.
Oh, so it's like rearranging the furniture to make a room look bigger.
Exactly.
But it doesn't actually change the space.
It's, all smoke and mirrors.
Yeah. Okay. So even seemingly minor reclassifications can have a big impact on our analysis.
Absolutely.
What about M&A?
Mm-hmm.
Can companies use mergers and acquisitions to mask their true financial picture?
Absolutely. A company that's struggling to generate cash might suddenly look a lot healthier after acquiring a business, that's flush with cash.
Mm.
But you got to ask yourself, is that sustainable growth?
Right. It's like putting a Band-Aid on a broken leg.
Yeah, it's a quick fix.
Yeah. So what are some things we should be looking for when we're evaluating those M&A deals?
Well, one of the things to really scrutinize is goodwill impairment. Companies might try to, understate the value of assets they acquire so they don't have to, take a big earnings hit right away.
It's like kicking the can down the road.
Exactly.
Yeah.
Yeah.
Okay, that seems like a red flag for sure.
Okay.
What are some other warning signs we should be looking for?
Well, keep an eye out for things like revenue growth.
Okay.
Is it way ahead of the industry average? That could be a red flag.
Okay.
Or maybe a sudden, unexplained jump in accounts receivable. That can also be a sign that something's not quite right.
Okay. So like in those crime dramas where the detective notices a tiny little detail
Right.
that everyone else missed.
Yeah.
How do we kind of train ourselves to be better detectives when we're looking at financial statements?
Well, comparing a company's financials over time and benchmarking against industry peers is key.
Okay.
Are they breaking from the pack?
Mm.
And if so, why? And, there are also some quantitative tools that we can use.
Like the Beneish model, right?
Exactly.
Yeah.
The Beneish model, it basically uses a set of financial ratios to calculate what's called an M-score. And the M-score, it's basically a probability score for earnings manipulation.
So the higher the score, the more likely they're doing something fishy.
Potentially.
Yeah.
It's not a foolproof method.
Sure.
But it can be a very useful starting point.
Okay. So we've talked about the spectrum of financial reporting quality.
Yeah.
Some of the potential pitfalls.
Mm-hmm.
But let's get back to the core concept here, which is earnings quality.
Yeah.
How do we identify earnings that are truly sustainable and not just a one-hit wonder?
That's where, distinguishing between recurring and non-recurring items in earnings becomes super important.
Okay.
You want to focus on profits generated from a company's core operations.
Okay.
That's what has staying power.
Right. So like we're looking for companies that can like consistently deliver the goods, not just like those one-off, big wins.
Exactly. Remember Enron?
Yeah.
They used non-recurring gains, to mask their true financial condition. They made it look like they were performing much better than they really were.
Yeah. Enron's definitely a cautionary tale for anyone in finance.
It is.
Speaking of like digging deeper,
Yeah.
I've always heard that cash flow analysis is like one of the best tools for assessing earnings quality.
Yeah.
Can you tell me a little bit more about that?
Absolutely. Cash flow is the lifeblood of any business, and the statement of cash flows can often reveal inconsistencies
Okay.
or red flags
Okay.
that we might miss if we were just focusing on the income statement.
Okay. So it's like following the money trail.
Exactly, yeah.
Sometimes like, the real clues are there.
They are.
Yeah.
And one of the most important things to look at is the relationship between net income and cash flow from operations.
Okay.
If there's a big discrepancy there, that could be a warning sign.
So if a company is reporting like strong profits, but weak cash flow, that's a bad sign.
Yeah, potentially. It could mean that they're manipulating their earnings.
Okay.
Or it could indicate, some deeper operational problems.
Okay. It's like a detective looking for inconsistencies in a suspect's alibi.
Right.
Like the numbers have to add up.
Exactly. The story has to make sense.
Yeah. Are there any examples of companies where like positive cash flow actually masked some deeper issues?
Yeah, take Alo Health and Beauty Care.
Okay.
They were generating really strong cash flow.
Okay.
But it turned out they were doing it by aggressively selling off assets and delaying payments to suppliers.
Oh, so not really, not sustainable practices.
Not at all.
Yeah. Okay. So even when it comes to cash flow, we need to be, critical thinkers and not just jump to conclusions.
Absolutely.
Anything else we should keep in mind?
Well, remember the concept of mean reversion.
Okay.
Unusually high or low earnings, they tend to revert back to more normal levels,
Okay.
over time.
So we're not trying to predict the future or anything.
Right.
But we should just be like realistic in our expectations.
Exactly.
Yeah.
And that speed of mean reversion, it can be affected by what's called the accruals component of earnings.
Okay.
These adjustments for, revenue earned but not yet collected.
Right. So accruals can sometimes make earnings look better or worse than they really are in a specific period.
Right. Exactly.
So if a company has a high proportion of accruals in their earnings, we should be a little bit wary.
Absolutely.
Okay. So now I think it's time to move on to some real-world case studies.
Yeah.
Companies that have, engaged in questionable or even fraudulent financial reporting.
Right.
Give me a company that really tried to like pull the wool over investors' eyes.
All right. Well, let's start with Sunbeam Corporation.
Yeah.
Now, they used a combination of what we call channel stuffing,
Okay.
which is basically, flooding your distributors with product to inflate sales numbers,
Okay.
and bill and hold sales,
Okay.
where they're recording revenue for products that haven't even shipped yet
Wow. Okay.
to really artificially boost their revenue.
So how could analysts, how could they have spotted those warning signs?
Well, one key indicator is what we call DSO, or Days Sales Outstanding,
Okay.
which basically measures how long it takes a company to collect its receivables.
Okay.
And Sunbeam's DSO, it was rising really sharply during this period.
Oh, so that should have been a red flag.
Absolutely.
Okay. So rising DSO can be a sign of, either trouble collecting cash,
Right.
or potentially channel stuffing.
Exactly.
Okay. What other case studies can help us kind of understand these tricky tactics?
Well, another really interesting example is MicroStrategy, a software company. Now, they took advantage of some ambiguities in accounting standards for what we call multiple element contracts.
Okay.
These are contracts that involve both products and services.
Okay.
And what they were able to do is prematurely recognize revenue.
So they were basically gaming the system.
Yeah.
To make their performance look better in the short term.
Exactly.
Right.
It highlights the importance of not just understanding the numbers, but also the accounting rules and how they can be manipulated.
It seems like becoming like a skilled financial analyst requires like a healthy dose of skepticism.
Absolutely, right.
Like you really have to kind of, dig deep and not just take things at face value.
Right. Never take anything for granted.
Yeah. Any other cautionary tales that you want to share?
Well, the collapse of WorldCom,
Yeah.
it's a really stark reminder that, even seemingly reputable companies can, succumb to this temptation to cook the books.
Yeah.
What they did is they capitalized expenses
Okay.
that should have been expensed, making their profitability look much better than it really was.
So they were pretending that expenses were assets.
Basically, yeah.
Okay. That's incredibly misleading.
It is. It's a very serious issue.
Yeah.
And it highlights the need for, strong corporate governance and vigilant auditors.
Yeah. So these case studies are really, a wake-up call, I think, for all of us.
They are.
That we can't just, take those reported numbers at face value.
Right.
We really need to think critically.
You do.
And use all the tools at our disposal to assess that financial reporting quality.
Absolutely. And speaking of tools, that brings us to balance sheet scrutiny.
Okay, so we've really dug deep into earnings quality. We've looked at some case studies. We've looked at cash flow. What about when we are looking at the balance sheet? What are some things to look out for there?
Well, I think one of the most important things is making sure assets and liabilities are being measured fairly.
Okay.
We want to see a balance sheet that reflects economic reality, not some inflated picture, designed to, impress investors.
Right. Are there any specific areas of the balance sheet that we should be paying extra attention to?
Well, intangible assets, especially goodwill,
Okay.
those can be a bit of a minefield.
Okay.
Goodwill isn't amortized, so it can just sit there on the balance sheet for years,
Okay.
even if the value has eroded.
So it's kind of like a ticking time bomb.
It can be, yeah.
How can we tell if goodwill is really worth what the company claims it is?
Well, one big red flag is a disconnect between a company's goodwill and its market value.
Okay.
Take Sealed Air Corporation back in 2012.
Okay.
Their goodwill was way higher than their market value.
Okay.
And guess what? They ended up taking a massive goodwill impairment charge that year.
Oh, so it's kind of like buying a fancy sports car that quickly depreciates in value.
Yeah.
You might look cool for a while, but eventually you're left with a hefty repair bill.
Right, exactly.
What other what other balance sheet shenanigans should we be on the lookout for?
Keep an eye out for the understatement of asset impairments.
Okay.
Companies might be reluctant to, write down the value of assets that have declined,
Okay.
especially if it means taking an earnings hit.
Right. So it's like pretending that your old clunker is still worth a fortune.
Exactly, yeah. You're trying to mask the true economic reality.
Okay. So we're looking for transparency and realistic assessments of asset values.
Absolutely.
What about liabilities? Can those be manipulated too?
Oh, absolutely. Companies might try to understate their liabilities
Okay.
to make their financial position look stronger.
Okay.
For instance, they might fail to record a contingent liability, like a potential lawsuit.
Oh, okay.
Again, it's all about painting that rosier picture than reality.
So it's kind of like sweeping your debts under the rug,
Right.
hoping no one will notice.
Exactly, yeah.
Okay. Are there any other tricks that we should be aware of?
Well, watch out for what we call off-balance sheet financing.
Okay.
This is where companies use, these complex structures to keep debt off of their balance sheets. It's a
Wow.
way of making themselves look less risky than they actually are.
So they're basically trying to hide their debt from investors.
Yeah, they're trying to make their financials look more attractive.
Okay. That's pretty sneaky. Are there any red flags that can help us spot these types of schemes?
Absolutely. A high debt-to-equity ratio, that's a classic warning sign.
Okay.
It indicates that a company is relying heavily on debt financing,
Okay.
which, makes them more vulnerable to, economic downturns or interest rate hikes.
Right. So it's like building a house of cards.
Yeah,
It might look impressive, but it can easily collapse under pressure.
absolutely.
Okay. What other ratios should we be paying attention to?
Well, a low current ratio,
Yeah.
that can be a cause for concern. It suggests that a company might not have enough liquid assets to cover its short-term liabilities.
So it's basically a measure of their short-term financial health.
Right.
Can they keep the lights on?
Can they meet their short-term obligations?
Yeah. What about inventory?
Yeah.
Are there any red flags we should be kind of thinking about there?
Yeah, actually, a high inventory turnover ratio can be a warning sign.
Wait, high inventory turnover.
Yeah.
I thought that was a good thing.
Well, it can be,
Okay.
but it could also mean that, a company is having trouble selling its products.
Okay.
And it's having to resort to, deep discounts or other aggressive measures
Okay.
to move that inventory.
So it's again, it's like everything in finance.
Right.
You really need to look at the context,
You do.
not just, one single ratio.
Exactly. It's about understanding the bigger picture.
Okay.
And, it's important to remember that these quantitative red flags, they're only part of the story.
Okay.
We also need to consider qualitative factors,
Okay.
like the company's industry, its business model,
Okay.
and its accounting policies.
Right. Because a software company
Right.
isn't going to have the same inventory levels as a manufacturing company.
Exactly. Different industries, different dynamics.
Yeah. And different accounting methods
Absolutely.
can lead to, different results.
They can.
So again, we got to dig deep.
You do.
Understand the nuances.
You got to understand the whole picture.
Yeah. Okay. So now let's shift gears a little bit and talk about cash flow analysis.
Okay.
Cash flow, like we said, is the lifeblood of a business. It's the actual money coming in and going out.
Yeah.
So important to really understand a company's financial health.
Absolutely.
I've always heard that saying cash is king.
Yeah.
But why is cash flow analysis so important?
Well, think about it this way. A company can show strong earnings on paper,
Okay.
but if those earnings aren't translating into actual cash, it could be a sign of trouble.
So we're checking if they're really making money,
Exactly. Yeah. We want to see that those profits are sustainable.
not just playing with numbers on a spreadsheet.
Right. Exactly.
Okay, so where do we even start? What are the key things that we should be looking for when we analyze a company's cash flow statement?
Well, the first thing we want to examine is their operating cash flow.
Okay.
This tells us how much cash the company is generating from its core business activities.
Okay.
And we want to see positive operating cash flow
Okay.
that's growing over time.
Okay, so if a company's operating cash flow is negative or it's shrinking,
Yeah.
that's a red flag.
It could be. It might signal that they're struggling to generate cash from their core operations.
Okay.
Which could, be a sign of deeper problems.
Okay. What about investing cash flow? What does that tell us?
Investing cash flow shows us how much cash the company is using to invest in future growth.
Okay.
Things like, buying new equipment,
Right.
acquiring other businesses.
Okay.
And we typically expect to see negative investing cash flow
Okay.
because that means the company is putting money back into the business.
So it's good if they're investing in their future,
Right.
but we don't want to see them spending recklessly or anything like that.
Exactly. We want to see a balance between, investing for growth and preserving financial stability.
Okay. And what about financing cash flow? What
Yeah.
insights can we get from that section of the statement?
Well, financing cash flow tells us how the company is raising and using cash
Okay.
related to its financing activities.
Okay.
So things like issuing debt or equity,
Okay.
paying dividends,
Okay.
repurchasing stock.
Okay.
And we generally like to see positive financing cash flow,
Okay.
which means the company's attracting capital.
But too much positive financing cash flow could be a warning sign, right?
That's right, because it could indicate that the company is taking on too much debt
Okay.
or relying too heavily on, external financing,
Right.
which can increase their financial risk.
Okay. So it's all about finding that sweet spot.
It is.
A healthy balance between operating, investing, and financing.
Yeah, you want that Goldilocks scenario. Not too much, not too little, just right.
Yeah, exactly. Are there any specific ratios that can help us analyze cash flow more effectively?
Absolutely. One really important ratio is the cash flow to sales ratio.
Okay.
This measures how much cash flow a company generates
Okay.
for every dollar of sales.
So the higher the ratio, the better.
Generally speaking, yes.
Okay.
It suggests that the company's efficient at converting sales into cash.
Okay. What about free cash flow?
Yeah.
How does that factor into our analysis?
Well, free cash flow is the cash flow that's left over after a company has covered, its essential capital expenditures.
Okay.
So it's the cash that's available to, pay dividends,
Right.
buy back stock,
Yeah, okay.
reduce debt,
Okay.
or reinvest in the business.
So it's like the cash that management has at its disposal to
Yeah.
create value.
Exactly. It's their financial flexibility.
Okay.
And the higher that free cash flow ratio, the better.
Okay.
It means they have more flexibility.
Okay.
And they're generating cash beyond, what they need just to maintain their current operations.
Oh, okay. That makes sense. What about a company's ability to meet their debt obligations? Like,
Yeah.
are there any ratios that can help us assess that?
Absolutely. The debt service coverage ratio, that's a really key metric
Okay.
for evaluating a company's ability to, generate enough cash to cover its debt payments.
Okay.
Lenders, they often use this ratio to assess a company's creditworthiness.
So a higher debt service coverage ratio means that they're in a better position to make their debt payments on time.
Exactly.
Okay.
It provides a measure of safety, for lenders,
Yeah.
and it helps them assess the risk of lending to that company.
Okay, so we've covered a lot of ground when it comes to cash flow analysis.
We have.
It's a critical part of understanding a company's, true financial health.
It is. It's fundamental.
Now let's talk about earnings quality.
Okay.
I know we touched on this a little bit earlier, but can you explain in more detail what earnings quality actually means?
Sure.
And why is it so important?
Absolutely. Earnings quality.
Yeah.
It's all about understanding how sustainable and persistent a company's earnings are.
Okay.
We want to know, are these profits built to last, or are they just a flash in the pan?
So high quality earnings are like a reliable workhorse.
Yes.
Consistently pulling in the profits.
Yeah.
Whereas low quality earnings are more like a one-trick pony.
That's a great analogy. Yeah. High quality earnings.
Yeah.
They come from a company's core operations. They reflect solid business fundamentals.
Okay.
They're not overly reliant on, one-time events
Okay.
or accounting gimmicks.
So how can we separate the workhorses from the ponies?
Right.
What factors should we be considering when we're evaluating earnings quality?
Well, several factors come into play.
Okay.
The company's industry is a big one.
Okay.
Some industries, like tech, they're known for high growth and innovation, but that also means their earnings can be more volatile,
Okay.
less predictable.
So it's like riding a roller coaster.
It is.
Exciting, but definitely not for the faint of heart.
Exactly.
Okay.
On the other hand, you have industries with, more stable and predictable business models,
Okay.
utilities,
Okay.
and they tend to have more consistent earnings.
So the business model itself can be a clue.
It can. Absolutely.
What else should we be looking at?
Well, don't forget about accounting policies.
Okay.
Some companies use very aggressive accounting methods.
Okay.
Like recognizing revenue too early to make their earnings look better than they actually are.
It's like putting on makeup.
Yeah,
It can enhance your appearance,
it can.
but it doesn't change who you are underneath.
Right. It's all about presentation,
Yeah.
not substance.
Yeah. So we need to really carefully scrutinize those accounting policies.
Absolutely.
To make sure they're not, masking the true picture.
Exactly.
Okay, so we've got, industry, business model, accounting policies. Are there any specific red flags we should be kind of, looking out for?
Well, one telltale sign is a high accruals ratio.
Okay.
This basically measures the portion of earnings that come from accruals,
Okay.
which are, those adjustments for timing differences
Okay.
between when revenue is earned and when cash is collected, or when expenses are incurred and when cash is paid.
Okay.
And a high accruals ratio, that can be a warning sign
Okay.
that a company is manipulating their earnings.
So it's like inflating a balloon.
Yeah.
It
might look impressive for a while, but it could easily burst.
Yeah, what other ratios can help us kind of gauge earnings quality?
Well, the cash flow to earnings ratio is another important one.
Oh, yeah.
This tells us how much cash flow a company generates for each dollar of earnings.
Okay.
A higher ratio is generally a good sign,
Okay.
indicating that those earnings are backed by real cash.
So it's like checking if they're walking the walk, not just talking the talk.
Exactly. And we also want to look at the trend in earnings growth.
Yeah, okay.
If a company's earnings are growing much faster than its revenue, that could be a sign that they're using accounting tricks to boost their numbers.
It's like sprinting ahead without building a solid foundation.
Right.
Eventually, you're bound to stumble.
Exactly. Sustainability is key. We want to see earnings growth that's supported by real business expansion and operational efficiency.
Okay, so we've covered the quantitative side of things. What about the qualitative aspects of earnings quality? What are some of the softer factors we should consider?
Well, the quality of a company's management team is crucial.
Okay.
If they have a history of, accounting scandals or are known for being overly aggressive,
Yeah.
that's a big red flag.
So reputation matters.
It does.
It's like choosing a doctor.
Hmm.
You want someone with a good track record
Yeah,
and a strong ethical compass.
exactly. You want someone you can trust.
Yeah. And corporate governance plays a big role as well, right?
Absolutely. Strong corporate governance helps ensure that a company is run in the best interests of its shareholders
Okay.
and reduces the risk of accounting shenanigans.
So it's all about checks and balances.
Precisely. And finally, we need to consider the overall business environment.
Yeah.
If a company operates in, a highly competitive or rapidly changing industry, it can be tougher to maintain high earnings quality.
It's like navigating a choppy sea.
Yeah.
You need a skilled captain and a sturdy ship to weather the storms.
That's a great way to put it.
So when we're evaluating earnings quality, we need to use both our quantitative and qualitative lenses.
Right.
And consider the company's specific circumstances.
Absolutely.
It's like being a detective piecing together all the clues to get the full picture.
It is. It's a holistic approach.
Okay, that makes sense.
Yeah.
Now let's shift our focus to another critical aspect of financial analysis. Understanding a company's risk profile.
Okay.
We've looked at the numbers, but how do we assess those broader risks that a company faces?
It's like putting together a puzzle.
Okay.
We've examined the individual pieces,
Yeah.
Earnings, quality, balance sheet, strength, cash flow patterns,
Yeah.
but now we need to step back and see the bigger picture.
Right, because even a company with seemingly stellar financials
Exactly.
can still be exposed to, significant risks that could really derail their future.
Absolutely.
So where should we start digging?
Well, the audit report is a great place to begin.
Okay.
While a standard unqualified audit opinion might not raise any red flags,
Okay.
a qualified opinion or even a going concern opinion should make you pause and dig deeper.
So it's not just about whether the numbers add up,
Right.
but also about the auditor's assessment of the company's, ability to stay afloat.
Exactly. Remember Eastern Kodak?
Oh, yeah.
Their audit report in the year before their bankruptcy filing included a going concern paragraph
Okay.
highlighting those serious doubts about their ability to continue operating.
Wow, that's a pretty clear warning signal.
It is.
Okay, so the audit report can give us some clues. What else should we be looking at?
The notes to the financial statements,
Yep.
they're an absolute gold mine of information.
Okay.
They often contain, detailed disclosures about contingent liabilities, pension obligations, financial instrument risks, things that could have a material impact on the company's future.
Those notes can be pretty dense, though.
They can be.
How do we even make sense of all that information?
That's where your skills as a financial detective really come in. You
Yeah.
need to be able to, sift through the details
That's
and
right.
identify those key nuggets that are relevant to your analysis.
Right. It's like panning for gold.
Yeah,
You have to work hard to find those precious bits.
exactly. And don't overlook the management discussion and analysis section.
Okay, the MD&A.
Yes,
Yeah.
the MD&A. It can offer valuable insights into management's perspective
Okay.
on the company's key risks and how they're being managed.
It's like getting a peek behind the curtain
It is.
and seeing how the sausage is made.
Exactly. While we always need to be critical of management's spin,
Yeah, of course.
the MD&A can still provide, valuable context and color.
Okay, so we've got the audit report, the notes, and the MD&A.
Yeah,
Are there any other sources of information that we should be considering?
absolutely. Don't underestimate the power of the financial press.
Oh.
Journalists often uncover, reporting issues
Okay.
or highlight risks that might not be immediately obvious from the company's filings.
It's like having an extra set of eyes,
Yeah,
watching the company,
right.
keeping them honest.
Exactly. Remember the Groupon case?
I do.
A financial journalist raised concerns about their internal controls over financial reporting, pointing out the challenges of, rapid growth and multiple acquisitions.
Okay, and those concerns were valid.
They were. Groupon later had to disclose a material weakness in their internal controls.
Yeah, so while we always need to verify information from the financial press,
Of course.
with those primary sources, it can still be a really valuable tool
It can.
for identifying potential red flags.
Absolutely. Might look impressive for a while, but it could easily burst.
Yeah. What other ratios can help us kind of gauge earnings quality?
Well, the cash flow to earnings ratio is another important one.
Okay.
This tells us how much cash flow a company generates for each dollar of earnings.
Okay.
A higher ratio is generally a good sign,
Okay.
indicating that those earnings are backed by real cash.
So it's like checking if they're walking the walk, not just talking the talk.
Exactly.
Right.
And we also want to look at the trend in earnings growth.
Okay.
If a company's earnings are growing much faster than its revenue, that could be a sign that they're using accounting tricks to boost their
It's
numbers.
like sprinting ahead without building a solid foundation.
Right.
Eventually, you're bound to stumble.
Exactly. Sustainability is key.
Okay.
We want to see earnings growth that's supported by real business expansion and operational efficiency.
Okay, so we've covered the quantitative side of things.
Hmm.
What about the qualitative aspects of earnings quality? What are some of the softer factors we should consider?
Well, the quality of a company's management team is crucial.
Okay.
If they have a history of, you know, accounting scandals or are known for being overly aggressive, that's a big red flag.
So reputation matters.
It
It's
does.
like choosing a doctor. You want someone with a good track record
Yeah.
and a strong ethical compass.
Exactly. You want someone you can trust.
Yeah. And corporate governance plays a big role as well, right?
Absolutely. Strong corporate governance helps ensure that a company is run in the best interests of its shareholders
Okay.
and reduces the risk of accounting shenanigans.
So it's all about checks and balances.
Precisely. And finally, we need to consider the overall business environment.
Okay.
If a company operates in, a highly competitive or rapidly changing industry, it can be tougher to maintain high earnings quality.
It's like navigating a choppy sea.
Yeah,
You need a skilled captain and a sturdy ship to weather the storms.
that's a great way to put it.
So when we're evaluating earnings quality, we need to use both our quantitative and qualitative lenses
Right.
and consider the company's specific circumstances.
Absolutely.
It's like being a detective, piecing together all the clues to get the full picture.
It is. It's a holistic approach.
Okay, that makes sense. Well, hey, I think that about wraps it up for us today.
I think so.
We've covered a lot of ground.
We have.
A lot of really important concepts to think about.
Yeah.
Hopefully this helps everyone out there, not just our CFA candidates, but anyone who wants to be a smarter investor.
Absolutely.
So until next time, keep digging deep.
Happy analyzing.